Let's return to the first fundamental question. Are BYD's technologies globally competitive? On a pure specification sheet, the answer might seem underwhelming. BYD's batteries, semiconductors, and autonomous driving systems don't always look like the world's best. KDL still leads in ultimate energy density with its nickel-rich Qilin packs. Wolfspeed and STMicro dominate in silicon carbide wafer scale and device sophistication. And in autonomy, Huawei and Baidu still demonstrate sharper precision in certain urban scenarios. But global competitiveness is not defined by the flashiest specs. What BYD has built is practical technology at scale, solutions that are reliable, affordable, and already deployed in millions of vehicles. And crucially, BYD has done this independently, taking control of nearly every layer of the ecosystem and achieving seamless vertical integration. That is where its strength lies. How likely is it that a technological breakthrough, such as solid-state batteries, could leapfrog BYD and erode its hard-won advantage? If there is one area where BYD's dominance faces its greatest test, it is in the next evolution of batteries. For all its success with the Blade architecture, the global race is now shifting toward the holy grail, solid-state batteries. These promise to rewrite the rules: higher energy density, faster charging, greater safety, and longer life. If achieved at scale, they could render BYD's Blade looks like an interim solution. Here lies the uncertainty. Toyota is targeting commercialization between 2027 and 2028, with true mass production likely around 2030. QuantumScape has demonstrated prototypes exceeding 300 watt-hour per kilogram, roughly 50% higher than Blade 2.0. CAT-L has unveiled its 500 watt-hour per kilogram condensed battery, a semi-solid design already pitched for aviation. Meanwhile, Hyundai, BMW, Volkswagen, and others are investing billions into partnerships with solid-state pioneers. BYD, for its part, has disclosed that its own solid-state battery is under development, with a demonstration targeted for 2027 and large-scale production around 2030. Yet compared with the bold announcements and aggressive timelines of its rivals, BYD appears cautious and understated, raising a crucial question: is BYD quietly confident or quietly falling behind? Against this backdrop of an accelerating race for solid-state supremacy, the risk of disruption cannot be overstated. For BYD, the consequences of lagging could be particularly severe. Its full-stack strategy, while a source of strength in stable times, may also make it harder to pivot quickly to breakthrough technologies emerging outside its ecosystem. And that leads to the next critical question. Could BYD's vertical integration, once its greatest advantage, become a liability in an era of rapid technological change? Is BYD's control of the entire value chain an enduring edge? Or could it become a liability if the industry shifts too fast for a closed ecosystem to adapt? BYD's defining strength is its full-stack strategy. Unlike nearly every other automaker, it controls the entire value chain: batteries, semiconductors, power electronics, software, and final assembly. In an industry where most players are at the mercy of suppliers, this degree of vertical integration is rare. And it has delivered tangible advantages. When global chip shortages crippled Volkswagen and NIO in 2021, BYD sailed through, producing uninterrupted thanks to its in-house IGBT modules. When the world's EV batteries production costs surged in 2022 due to raw material shortages, BYD remained unaffected as it leaned on its own LFP Blade batteries designed around abundant materials. In times of gradual evolution, when industries shift incrementally, this independence looks like the ultimate moat. But vertical integration is a double-edged sword. BYD's self-sufficiency gives it resilience, but also locks it into its own ecosystem. Where Tesla or BMW can simply switch suppliers if a better battery emerges, BYD cannot. Its factories, supply chains, and product roadmaps are tied to its own technologies. If the next disruption comes slowly, BYD can adapt. But if it comes suddenly, say, in the form of a commercially viable solid-state battery or a dominant autonomy platform set by Baidu or Huawei, BYD could find itself trapped. Its greatest strength could become its greatest liability. There is also the risk of opportunity cost. By focusing resources on mastering every link of the chain, BYD may spread itself thin compared to competitors who specialize. A Huawei, free from the burden of manufacturing, can pour its efforts entirely into autonomy algorithms. A Cat L, unconcerned with making cars, can sprint ahead in cell chemistry. BYD's broad control brings coherence, but it risks falling behind in the bleeding-edge races where specialization matters. In short, BYD's full-stack strategy is an enduring advantage as long as the industry evolves incrementally. It ensures resilience, cost control, and seamless integration that few can replicate. But in the face of sudden technological leaps, it could become a liability. Trapping BYD in its own ecosystem and leaving it vulnerable to disruption it cannot easily absorb. Where are we in the EV cycle? Has China's domestic market already matured, or are we still at the start of a longer global growth curve? The most pressing question for investors is no longer whether electric vehicles are the future. That battle is already won. The real question is, where are we in the cycle today? Is BYD still climbing the early slopes of a long growth curve, or has it already crested the peak of its domestic boom? The answer is complex and requires us to weigh 4 dimensions: China's domestic market, government regulation, the global stage, and geopolitics. China's domestic market, after years of relentless government support, subsidies, tax breaks, license plate privileges, China's EV market has exploded. By 2025, new energy vehicles account for more than half of all new car sales, a penetration rate unmatched anywhere else. In many urban markets, the adoption curve has already steepened, and growth is beginning to slow. The signals of maturity are clear. In 2025, BYD reported its first sequential sales decline since the pandemic. At the same time, Beijing has shifted its stance, no longer subsidizing aggressive growth, but tightening rules to stabilize the industry. The inevitable result? A brutal price war. Dozens of brands slash prices in a saturated market, fighting for survival in an overcrowded field. Yet here lies a paradox. What looks like carnage could be BYD's opportunity. With unmatched scale, vertical integration, and cost leadership, BYD is among the few strong enough to endure. As weaker players run out of cash or collapse under new rules, the battlefield will narrow into an oligopoly of giants, and BYD will almost certainly be among them. Government regulation. New regulations add to the strain. Automakers must now settle invoices with suppliers within 60 days, a sharp break from the old habit of stretching payables to manage cash. For BYD, this squeezes near-term cash flow. But in the long run, the policy is merciless to fragile rivals who relied on delaying payments just to stay afloat. Strong players will survive the sting. Weak ones will bleed out. For BYD, the short-term pain may harden into long-term dominance. The price war. There are early signs the worst may be over. Regulators have warned against malicious competition. Smaller names are falling by the wayside. As survivors stabilize, the pressure to undercut may ease, giving room for margins to recover. If that happens, BYD, already the cost leader, will be the biggest beneficiary. The global stage. If China feels late cycle, the rest of the world is just beginning. Southeast Asia, Latin America, and the Middle East are in their early innings. Sales are doubling off low bases. Governments are rolling out subsidies, charging networks, and local assembly plants. For BYD, whose strength lies in affordable EVs built at scale, this is fertile ground to replicate its domestic success. The bigger prizes are Europe and the United States. But both are complicated. Europe embraces electrification, yet defends its homegrown automakers with tariffs on Chinese EV imports. The US remains even more hostile. Tariffs exceed 100%, and with the Trump administration returning, trade policy is a wild card. For BYD, these aren't unreachable markets, but they are hostage to geopolitics. So, where are we in the cycle? In China, the EV boom is at its peak. Growth is slowing, competition is fierce, and the next phase is consolidation. BYD will likely emerge as one of the survivors, but absolute growth will be harder to come by. In emerging markets, the cycle is at its beginning. For BYD, Southeast Asia, the Middle East, and Latin America could form the new frontier of expansion. In the West, the cycle is frozen. The opportunity is massive, but locked behind tariffs and politics. The next 3 years will be defined not by technology, but by geopolitics. The billion-dollar question now is, can BYD continue to maintain its growth trajectory in such an uneven EV market? Does BYD's valuation as of today properly reflect both the risks and the rewards embedded in the answers to the first 4 questions? Let's look at the valuation from PE's perspective. At today's price of around HKD 108 per share, BYD trades at a price-to-earnings ratio of roughly 21. What does this imply? In simple terms, the market is pricing BYD to grow profits by at least 10% annually for many years ahead. Is that a demanding hurdle? Not really, at least not for a company like BYD. Historically, its profit growth has far outpaced that number, driven by relentless volume expansion, rising economies of scale, and its vertically integrated model. Even in the midst of a bruising price war in China and new entrants in emerging markets, a 10% earnings growth assumption does not seem unrealistic. If anything, the bigger question is not whether BYD can grow, but whether it can continue to defend its moat when the game changes. On the domestic front, consolidation is already favoring giants like BYD. On the global stage, its affordability advantage positions it well for Southeast Asia, Latin America, and the Middle East. As the price war eventually cools, margins may stabilize, offering further tailwinds. So at PE21, the market is not pricing in perfection. It is pricing in steady, mid-teen growth from a company that has already delivered far more. The valuation is therefore neither stretched nor cheap. It is a bet that BYD's strategy of practical technology at scale will keep translating into profits year after year. Next, let's examine BYD's intrinsic value. Strip away the narratives, and intrinsic value ultimately comes down to free cash flow, the lifeblood of any business. From 2020 to 2023, BYD's free cash flow rose from CNY 33 billion to CNY 47 billion, compounding at roughly 12% annually. That was impressive, reflecting both the scale of China's EV boom and BYD's operational strength. But in 2024, momentum faltered. Free cash flow slipped back to around CNY 36 to 37 billion, with consensus expecting only a mild rebound to CNY 39 billion in 2025. This slowdown highlights three structural pressures. Price wars. Aggressive discounting to defend market share continues to squeeze margins. Working capital tightening, new rules requiring automakers to pay suppliers within 60 days, have reduced cash flow flexibility. Heavy capex, sustained investments in batteries, semiconductors, and overseas expansion continue to weigh on free cash flow. Taken together, these factors reveal a growing disconnect between BYD's headline growth and cash generation. Sales may surge, but cash flow tells a more restrained story. To stay conservative against this backdrop, I ran a DCF model using the following assumptions. Discount rate, 10%. Free cash flow growth, 8% annually for the next 7 years. Terminal growth, 4% thereafter. Under these parameters, BYD's intrinsic value comes out to roughly HKD 109 per share, close to the current market price of around HKD 108, but well below analysts' targets, clustered between HKD 150 and 180. Of course, DCF models are not crystal balls. They are approximations shaped by assumptions. Yet the wide gap with analyst forecasts suggests that the market is pricing in a far more optimistic recovery, one that assumes stronger free cash flow growth, firmer pricing power, and smoother global expansion. That outcome is still possible, but it would require disciplined execution in emerging market expansion, a friendlier trade environment with the US and Europe, and no major technological disruption along the way. My take as an independent investor. Having assessed BYD through the 4 fundamental questions and examined its valuation, here is my view. Strength today, but vulnerable tomorrow. BYD's strategy of scale and vertical independence has positioned it as the clear winner in today's EV landscape. Yet its greatest risk lies in technological disruption, most notably the rise of solid-state batteries, where competitors are already investing heavily and BYD remains comparatively quiet. The double-edged sword of full-stack control, BYD's full-stack model is a powerful advantage in stable times, but it also locks the company into its own ecosystem. If the industry pivots sharply toward a disruptive technology, BYD may find itself slower to adapt than rivals who can simply switch suppliers. BYD's growth trajectory in an uneven EV market is unclear. China's EV market shows signs of maturity, with growth slowing and competition intensifying. Industrial consolidation will likely benefit BYD in the long run, while regulatory tightening hurts in the short term, but strengthens the system over time. Beyond China, emerging markets like Southeast Asia and the Middle East present new opportunities, while the US and Europe remain constrained by tariffs and geopolitics. Taken together, growth is still possible, but expectations must be tempered. Valuation is fair, but not compelling. At today's price of around HKD 108, the market is pricing in cautiously optimistic assumptions. My conservative DCF model, which factors in softer free cash flow growth, yields an intrinsic value of roughly HKD 109, essentially in line with the current market level. Analysts are far more upbeat, with target prices clustered between HKD 150 and 180. While such outcomes remain possible, they are conditional, dependent on disciplined execution in overseas expansion, a more favorable trade environment with the US and Europe, and the absence of major technological disruption that could alter the competitive landscape. Conclusion: a moderate risk, moderate return profile. In the near term, BYD remains relatively safe, supported by its scale, vertical integration, and strong profitability. But over the medium term, technological disruption and EV market uncertainty elevate its risk profile. The global EV boom in emerging markets offers promise, yet expectations should remain tempered. For me, BYD represents a moderate risk, moderate return play, not a phenomenal one. As an investor who seeks asymmetric risk-reward opportunities, BYD is not my preferred choice at current levels. Unless it demonstrates clear progress in next-generation battery technology, stronger free cash flow recovery, and a sustainable edge in overseas markets. And perhaps this explains why Warren Buffett chose to exit. While unproven, it's possible he saw the same paradox. A company that dominates today, but stands increasingly exposed to technological shifts and market unpredictability tomorrow. His retreat may not be a verdict against BYD's greatness, but a recognition that the easy money has already been made. And again, the above is just my personal view on BYD and should not be taken as financial advice. Please do your own due diligence and consult a qualified professional before making any investment decisions. Feel free to share your thoughts in the comments, whether you agree or disagree. Goodbye, and have a great day.